Well, we're at the iconic Central Park in conversation with Morgan Stanley's Ruchir Sharma. Ruchir, appreciate you joining us on CNBC TV 18. September last year is the last conversation that we had when we were here in the US tracking Prime Minister Modi's visit. And then you were talking about how India was in the midst of a hope rally. And historical data shows that the first year of a government is when you actually see the markets go up. And unless and until the government backs it up with reforms, year two is a year of correction. Are we in the year of correction in India today?
Well, it seems to. I mean, that's what the market's verdict is, that there was a lot of hope built up in the first year. We got some incremental change, but not the kind of big bang reform that some people were expecting. And if you look at the history of other big leaders, that's what tends to happen, that if you do not get that big bang reform in the first year, it's very difficult to do that in the second year or in the third year, because then the opposition tends to regroup. And
but let's talk about these big bang reforms, okay? Everyone talks about how the government ought to do big bang reforms. But what would the market have liked to see in terms of big bang reforms?
Well, the single biggest thing which we spoke about even last time, and something that I've written about, is the fact that something needed to be done about the public sector banks. You just cannot have a system where 70% of the assets are controlled by public sector banks, and the public sector banks have such large non-performing loans which are not properly recognized for a long period of time. That's just a lot of rot in the system. When the basic rules of growth is you need credit growth to try and fuel growth. Not excessive credit growth, but some credit growth. And that's being choked. So I think the fact that that's not been addressed and not enough money has been spent to try and solve that problem, to me, has been one of the biggest missed opportunities in the first year, if you ask me.
So you think the Reserve Bank governor writing to the finance minister saying you need to put in more money as far as recapitalization is concerned is the need of the hour today? And if the government were not to heed to that advice, we're going to be going down a sorry road?
Well, I think so, but I think that even more could have been done. I agree that now it can't be done, but in the first few months you can argue that some major stake sales in public sector banks, not privatization, because that's a taboo word in India.
Well, they said that they could bring it down to 52%. I mean, that was the...
Or, some innovative solution about, doing something below 52% with non-voting shares. Something like that needed to be done. And I think that's not what we have seen. And so to me, that's one of the biggest constraints for growth currently.
Okay, so that's the one big miss. What are the others?
Well, I think that in terms of doing something in terms of allocating more money away from some of the subsidies to infrastructure projects, that really is the modern day debate. In the old days, the debate in economics used to be guns versus butter. The modern day debate really is subsidies versus infrastructure. You have to all understand there's only that much money that a government can spend. And the private sector is not good at infrastructure. If you look at historically, it's really the public sector which plays a dominant role in infrastructure. Like China spends 10% of its GDP on infrastructure. But the reason why it's able to do that, because it doesn't spend that much on subsidies. It didn't do that for 20, 30 years. But don't you think they're making the
right moves? They are sort of now trying to link everything to the DBTL. They're even talking about kerosene being linked to DBTL. Don't you think that at least directionally they're headed in the right way as far as subsidy rationalization is concerned?
The changes have been incremental, but nothing which is big bang, and that's fair in terms of the fact that maybe in India we can't see these big bang reforms. The political economy doesn't allow for that to happen. But whatever had to happen, according to me, needed to happen the first few months when the political capital was at its peak. Now the political capital is beginning to decay, and it's very difficult to get that done. And what we're seeing in the market is exactly that. There's an expectations reset which is going on, which is the fact that the hope that India could be the next economic miracle is sort of being dialed back. I'm not saying it's sort of being extinguished, it's being dialed back. So what we have now is a path where the Indian economy can grow at 6 to 7%, but not
8.5% or 9% or 10%, which is the government's projection.
I think those government projections are completely off the mark, and even more so because, as
you don't buy the GDP numbers.
I think the GDP numbers are complete nonsense, right? In terms of, I really feel that this is the most ridiculous thing that I've seen from any country in the recent past.
Is it hurting India's credibility instead of actually boosting our confidence?
Of course it is. I mean, at a time when the global economy is growing at a pace of little more than 2%, and the growth rate in emerging markets has halved from a rate of 8% at the peak last decade to less than 4% just now, and ex-China it is just 2.5%. To claim that the Indian economy is growing at 7.5%, with exports slumping, which was the big contributor to growth last decade, is absolutely ridiculous. Because where are the signs of this domestic boom? So there's something called a measured economy and something called an experienced economy. Who is experiencing this 7.5% economic growth in India? I want to know who these people are. So I think that this has been the single biggest falling of this government, which is not to have put an end to this controversy much earlier and to have used this data to falsely claim that we are growing faster than China. You know, yes, China's economy is slowing down, and to compare with China is anyway misleading. But to sort of go ahead with this data, to me, has been the single biggest pitfall of this government.
You know, I want to address the China issue because I remember you wrote that China slowing down shouldn't be seen as a victory for Narendra Modi's government.
Right.
And you're absolutely right. It is misleading to do this India-China comparison because, you know, you've written about how China's economic miracle has already happened and we're still aspiring, you know, to create an economic miracle for ourselves. How do you see now the India-China context? You know, there's a lot of talk about Modi's visit to China and how expectations on the India-China front have been reset. Do you really believe that?
As you know, like I really feel that these groupings are just, you know, great marketing exercises with absolutely no fundamental value. So comparing India and China is cool because these are two large economies based in Asia. But there's nothing in common between them, even in terms of size. I mean, the Chinese economy is multiple size India's economy. India today is where China was about 20 years ago or so. So these comparisons are completely misleading, according to me. But having said that, I think that, sure, we can aspire to be like China and try and grow as fast as China did. But then we have to sort of understand what exactly China did. They took some pretty big risks with economic reforms. Every few years, they took some very big risks, and those risks paid off. If you're not willing to take those risks, we should not aspire to be that. Instead, the attitude in India often tends to be, where else will the money go? It's got to come to India. This is the best story in the world. And you hear these cliches and these banana statements.
And it's no longer the best story in the world?
No, I'm saying that, you know...
I mean, even the folks at Morgan Stanley back in India say that India is the only game in town, but you don't buy that?
No, I think that's very dangerous analysis, according to me, because that leads to complacency. That sort of, you know, makes it believe that where else will the money go? It's got to come here. You know, this is the only place where it will go. These dynamics shift very quickly. And we're also like in an environment, let's not forget, where the overall environment for emerging markets is not that conducive. The overall flows to emerging markets haven't been that strong. And this is not what the case was last decade. Once again, we tend to have, I think, a very insular analysis of what's happening just in India, not realizing that we are operating in a global world out here, in a very globalized world out there. I mean, the last decade's boom was a lot to do with the global emerging market boom. Even if you look at the stock market, around half the earnings of the stock market really come from external sources. So, you know, we try and sort of project how much the stock market earnings will be or growth will be based on what the domestic economy is doing. But there's also like an external economy. That external economy affects both our growth rate and also half the earnings of the stock market. And I think that's something which is forgotten in this entire analysis, which is very insular only about India.
So let's talk about the risk to capital flows, especially into countries like India and the emerging market basket. If we're not the only game in town, what do you anticipate in terms of capital flows? And especially if we do see the Fed move in September or December, I don't know what your take is on that, given what we've heard from Janet Yellen.
Yeah, I think that as I said, so even in September, when we last, did this interview, that my basic analysis is that that flows in general will not be very strong, because I think that a lot of money which has gone into emerging markets over the last decade is sort of tired money. And even in the case of India, you have many stale bulls in the international investment community. So to expect too much capital flows into India is going to be a bit of a stretch. And also, I think that globally, we really have to be mindful of one thing, that we've been in this super easy liquidity environment in the last few years. And that liquidity environment is only going to get less favorable in the coming couple of years. What that exact pace is still up for debate, but it's going to be less favorable. And so it's going to be much tougher to compete for money in that environment. So I do not expect flows to be anywhere as strong as they were last decade. And I think that it's going to be a lot more difficult. And even internationally, as I've written, I really feel that asset prices are very high everywhere. In every single place, asset prices have been inflated by super easy liquidity conditions. And as the Fed does some sort of normalization, you should expect asset prices to do not that well. In the case of the US, you look at the point here. We have gone through now one of the longest spells in US stock market history without even a 10% correction. Right? And that's because many people believe that good news is good news, that if the Fed sort of doesn't raise interest rates, even that's good news. So bad news is also good news, because it won't raise interest rates because you believe that the Fed is sort of concerned about the economy. And if the economy does well, that's good news anyway. That sort of analysis, I think, has led to a lot of complacency among stock market investors and investors worldwide. And it's only natural to expect that you're going to see some sort of a correction take place out there, which is also going to affect India over the next 6 to 12 months. I mean, how long is the US stock market going to go on without even a 10% increase, 10% correction? That just is very unrealistic.
You know, so speaking of corrections now, and you talk about a 12% correction, that's what historical data suggests in year 2 of a government. We've already seen that in India. How much more of a downside do you expect then, given the fact that you're not seeing the kind of big bang reforms that you would expect, and the government seems to be moving on incremental reforms, and you don't believe the growth numbers that the government is putting out, and we actually haven't seen things turn around for the economy?
But I think we've seen some sequential improvements. You know, like you take away the headline numbers. I was there in India recently, and what I think that I do see is some sequential improvement in terms of some of the consumption indication do suggest that in the months of April, May.
Well, we've had a good IIP number come out.
That's a one-month number, but in general, I think we've seen some sequential improvement. So maybe the economy is not growing at 7.5% as projected. Maybe it's growing at 5.5%, 6%. But that's possibly better than maybe 5%, which was there like at this time a year ago. So I really feel that we've seen an improvement as far as the Indian economy is concerned. It's just that the improvement is not as strong as people expect it to be, and those sort of inflated expectations are being snuffed out. So I don't see India doing much worse in relative terms from here. But in absolute terms, the risk remains that if you do get an international correction, finally the US corrects, and at some point at the end of this year, as the Fed does increase interest rates and you do get a correction, that is undoubtedly going to affect us in absolute terms.